Welcome everybody to today's webinar. My name is Thomas Wood, for those of you that don't recognize my voice. I'm a partner and director of trading operations here at Basecamp Trading. Also run the futures trading room. Today we're going to be talking about intro to trading bull and bear flags, what those are. We're going to talk about timing entries into trades and how timing entries are useful, but we'll go into that more here in just a minute. But really quick, before we do that, it's always fun to find out where everybody is joining us from. So where are you coming in from? Where are you joining us from in the webinar? I personally am in North Carolina, Lewis in Connecticut, Britt in Sweden, Michigan, Pennsylvania, New York, sorry, it's going too fast, South UK, Southern Maine, Denver, Colorado, Ottawa, Canada, Woodhaven, Michigan, Knoxville, Tennessee, Calgary, Alberta, Boston, Queen Creek, Arizona, Montana, Detroit, two people from Detroit, Isaac and Carrick, Port Elizabeth, South Africa, Las Vegas, Nevada, North Carolina, Supply, North Carolina, Northern California, Long Island, Kansas, Reno, Texas, Toronto. Good deal. Coming from all over the place, and I apologize if I didn't say where you were from. I mean, there's just a lot of hundreds of places going by right now on the screen. But glad to have you all with us. Today's going to be a fun day. We're going to talk about, like I said, timing entries with bull and bear flags and how the bull and bear flag indicator works. So you guys can see a little bit about it. But before we get going with the good stuff, we have to go through the risk disclaimers really quick. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. BasecampTrading.com is taking reasonable measures to ensure the accuracy of the information contained herein. However, BasecampTrading.com does not guarantee its accuracy and is not liable for any loss or damage that may result directly or indirectly from such content or from an inability to access such information or delay in or failure of the transmission or receipt of an instruction or notification in connection therewith. Any past performance results shown for illustration example only are hypothetical and as such have many inherent limitations. No representation is being made that an account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. And then along those same lines, we're required to show you CFTC Rule 4.41. This is just a hypothetical disclaimer saying, look, if we're showing you examples from the past, obviously there's no guarantee that they're going to happen again in the future. Plus, we'll be showing you some back-tested results and stuff, and obviously no guarantee that back-tested is not indicative of future results. So that being said, we trade these strategies every day in front of hundreds of people from around the world, and we wouldn't be doing it if we didn't believe they worked. I wouldn't be putting money on them if I didn't believe they worked. Alrighty, so now we can slow down. For those of you that don't know me, this is me, Thomas Wood, my beautiful wife, Dora, and our little dog, Merlin, who's not really, I guess, that little. And one thing I get a lot when I show people who I am is they go, wow, Thomas, you are really young. And I go, yeah, okay, I understand where you're coming from, but I've been trading since I was about 13 or 14 years old and have already spent more time trading real money than most people will in a lifetime, right? I got started in this industry. When I first got started, my dad's the one who got me into trading. And the reason I got started in trading education is because when my dad was showing me how to trade, he had quote unquote gurus trying to teach him. And he lost hundreds of thousands of dollars following these guys. And I just didn't think that was right. And I wanted to be the exception to the rule and actually help people like my dad and make it so that other people can actually see what trading is and see that it's not really that difficult as long as you have certain rules and guidelines that you're following, and that really anybody can be successful with trading. So a lot of people ask me, well, what kind of profits in equity curve do you have? Well, this is my equity curve over the past two or three months. Not too bad. This is just on one of the accounts I trade. This is a broker statement. I can show this because the account's no longer active, but this is a broker statement from a couple of years ago showing this is 1 day of trading and it has about $37,000 in profits. So I've been blessed and fortunate enough to have been able to trade large sums of money and smaller sums of money. But I've been in a point in my life where I've made more money trading in 1 day than most people will make in a year type of thing. Now, that being said, I'm not here to tell you that you have to trade like me to be successful, because I don't believe that. And honestly, normally I don't ever show any of this stuff about me. It's just there's been some people that have complained, hey, you're not even trading live. Well, yeah, I am. But what I always try to show people is, let me show you what my students have done. Let me show you what other people I've helped them achieve. And I'll show you at the end of this presentation equity curves from other traders that I've worked with that are amazing. And I mean, their equity curves, some of their equity curves are even better than mine. And I'm really, really proud of them. And the reason I want to show that is because I want to show you what you can do. Anybody can go say, look how good of a trader I am. But I want to show you, look at how good of a trader I can help you become. Okay? So with that being said, where are you currently with your trading? What type of trader are you? You're going to be in one of three categories. You're either going to be retail, meaning you're just trading on the side. It's not your main source of income. It's not how you pay your bills. Professional, meaning it is your main source of income. It's how you pay your bills. It's how you make money. Or institutional, meaning it's not only how you pay your bills, but you trade other people's money as well. So if you had to classify yourself in one of those three categories, which one would it be? Retail, not making enough profits. Retail. Professional, good deal. Retail. Now, I've worked with traders, thousands of traders from around the world. I've worked with everybody ranging from institutionals trading literally billions of dollars to retail traders trading a couple $1,000 accounts. All right. And there's certain things that we try to teach that no matter where you're at with your trading hold true. All right. And I'll talk about one of those here in just a minute. But where do you want to be? My next question for you is, where do you want to be with your trading? Where are you trying to get to? If you're retail now, which the majority of you are, where are you trying to go? Are you just trying to stay retail, meaning you just want to get some supplemental income, help boost your retirement? You want to become a professional where you're paying your bills using your trading profits? Or are you trying to get to the point where you're institutional? Now, let me tell you a story. One of our members, Dave, who's no longer with us, he passed away recently, but he was a really good friend of mine. And he became a member of Basecamp Trading about 2 years ago. And he was somebody I consider a friend. All right. But when he came and first started working with us, he said, look, I want to become a professional trader. I want to be doing this for a living. And he goes, I've never failed at anything in my life. I've studied trading more than anything else in my life. I've literally built a multi-million-dollar business from the ground up on credit cards. All right. But trading, it seems like the more I try, the harder I try, the worse I do. How many of you feel like that's true for you? Where you go, it seems like the more I try, the faster I lose money. The harder I do this, the steeper my equity curve goes from upper left to lower right. Me too. Oh, yes, that's me. Yep, absolutely. Challenge is consistency. Yep. And we'll talk about consistency here in just a minute, Jerry. Well, I'm happy to say that Dave, before he passed, for about 5 or 6 months before he passed away, he had achieved his goal of becoming a professional trader. He started off with about a $10,000 account, and he was well over a $100,000 account, and he was living off of the money he was making trading. And I was really, really proud of him. He did an amazing job. And I'll show you what his equity curve looked like so you can kind of see what it takes to become a professional trader. But how many of you look back? My next question for you is, how many of you look back at the trades you place on a day, any given day, week, month, whether you're a day trader, swing trader, and you see where you went long or short, only to immediately have the market turn around, stop you out, and then go right back the direction you thought it was going to go? So let's say you got long, market pulls back, knocks you out, and then turns around and goes right back up. How many of you have that happen to you? Or you get into a trade that you think is a really good trade, and then all of a sudden it turns around and reverses on you. So you get caught in something like a false breakout. All the time. Talking about me. Futures have your number there. Yeah, it seems like the market's out to get you, right? Now, how many of you look at the trades that you're placing, you can say, you know what, if I could just lower my risk, if I could lose a little less money on my average trade, or my average loss, my strategy would be excellent. Meaning you're risking a little bit too much on your trades for the amount of money that you're actually making with your winning positions, with your winning trades. Because one recurring theme that we see with a lot of the traders that we've worked with, especially retail traders, is timing entries. Okay, and timing your entry is very important. The reason timing your entry is important is because that's how we decrease our risk. If we have a really well-timed entry, the market should move our direction right away. We can have a much tighter stop loss. We don't have to risk as much money. We don't have to sit around waiting for it to move our direction. And like I said, that's a big problem, because if you don't time your entry correctly, it's going to hurt your reward risk ratio by lowering or by increasing the amount that you have to risk in order to let that market move. All right. And I'll talk about here in a second how you do that. Now, consistency is our goal, right? As a trader, in order to be someone that's going to be trading professionally or trading long-term, you want really consistent returns. All right. Now, in order to do that, there's not just one half of the equation. One thing that a lot of retail traders come in thinking as they go, in order to be a profitable trader, I have to be right 80% of the time. And that's not true. All right. You don't have to be right 80% of the time. You could be right 20% of the time and still be a really good profitable trader with a really nice equity curve. The way to profitability and the way to consistency is getting a balance between your reward risk and your percent win. Okay. Meaning you could have a 20% success ratio or success rate, but you have a 20-to-1 reward risk, meaning you make 20 times your average loss on your average winner, and that's still a really good strategy. Or you could have a 1-to-1 reward risk ratio and have a 75% win rate, and that's still a pretty good strategy. Okay, so there's not any one number that you have to achieve. It's a balance, and each trader is different. Each person has their own, what we call risk personality or trading personality, or some traders like to trade counter trends. Some traders like to trade with trends. Some traders like to trade options. Some trade futures. Some trade Forex. Some trade equities. And there's not any one way. I'm not going to sit here and say you have to trade like this to become a successful trader, because I don't believe that at all. There's hundreds of ways to make money, and I'll show you one of them today. But you have to decide which one fits your personality. Okay? Now, with that being said, the other thing you got to remember is trading is not just a flip the switch and all of a sudden you're going to be rich. It's a journey. Dave, for example, it took him about a year, six months to a year, to get to the point where he was consistently making money. All right. So it's different for each person. Obviously, there's some people that learn it a lot faster, some people that catch on much quicker and start placing trades and making money much sooner. Others take a lot longer. It just depends on you. All right. And we understand at Basecamp Trading, and we want you to understand that it's not just to go out and do it, but it's a journey. And one of our goals is to help guide you along that with that long-term commitment and help you get there and achieve your goals. But it's not an overnight fix. All right. Now, by the end of the presentation today, you're going to have a pretty good idea if Basecamp Trading is a good fit for you, and if this way of trading that I'm going to show you today is good for your strategy, for your style. But if it's not, that's all right. Like I said, there's hundreds of ways to trade the market, so I'm not here to tell you this is the only one. All right. Now, what do we do with Basecamp, and why are we a little bit different? One of the things we hear a lot is traders, they go out to a webinar or something and they get this indicator that they think is going to be the end all be all. It's the best indicator in the world. And then they go start trading. And once they purchase that indicator, the people that sold it to them say, okay, good luck. You're on your own. Have fun. They kind of get dropped off on the side of the mountain. So the way we do this is we kind of call it the Summit Framework. And we take you through a 3-step process. Step 1 is Basecamp. And in Basecamp, we have Acclamation. This is where we're going to give you the foundation, the fundamentals of trading. You're going to learn things like how to put together a trading plan, how to put together a trade log, reward risk ratio, how that works, how you need to increase or decrease reward risk and percent win, how to get that balance. Talk about the fundamentals of price action reading. We're going to talk about managing your psychology and understanding getting your mind right, because it is a big mental game, trading is. And all that's going to be in Basecamp. That's step 1. And these are all things that we find are overlooked all the time by traders when they're trying to get into this industry. They go, I'm just going to go start doing it. And they don't know the basics yet. Then we take you from base camp into the ascent. And the ascent is what we call peak trader development. All right. And this is where we start giving you some indicators, and we start giving you more knowledge on different strategies and ways of trading: trend trading, counter trend trading, hedging, options trading, futures trading, equities trading, all the above. And we start teaching you more strategies and different methods of trading. So then you can start going, all right, I like this way and I like using this way. And you start picking little pieces that you like and putting them together into your trading toolbox and putting together your trading plan and kind of the way that you're going to be moving forward. And then we move you into Everest, and Everest is launching the end of this month. And Everest is going to be about 100 hours of training, roughly. And it's going to teach you everything we know. And then you're going to take all that knowledge, and it's going to be continued education where we keep meeting and keep meeting and keep meeting. And it's going to be putting together a strategy and a plan and start implementing that plan and getting you to the point where you're actually trading, placing trades, and moving in the direction that you want to be moving, hopefully. All right. So again, by the end of the presentation, you should have a pretty good idea if we're a good fit for you. And if we are, I'll show you how you can take the next step. If we're not, that's all right. No pressure. Okay. So what are you going to learn today? Because I always want to try to teach you something if you're spending time out of your day to come spend with me. So we're going to talk about a couple different topics. Number one, we're going to talk about using momentum to identify what we call a bull or bear flag setup, which is a continuation pattern. It's not getting in at the start of the move. It's getting in once a move has begun, and then timing that entry correctly into a move that has already started and catching the continuation. All right, we're going to talk about the bull bear flag indicator, how that works, what it is, how you read it, how you use it. Then we're going to talk about how timing entries, and well, throughout the whole thing, you'll learn how timing your entries with bull and bear flags can do two things. It can potentially increase your reward risk ratio by lowering your risk, and also potentially increase your win rate by helping you avoid false setups or false breakouts or head fakes where the market looks like it's going to go somewhere but then doesn't. Okay, so why do we want to use the bull bear flag? Why do we want to use bull and bear flags to time our entries? Well, one of the things it does for us is it helps us when you're using the indicator. It helps you quickly and easily identify a potential setup and entry. Okay, because it'll pop up on your screen. There'll be a dot, and you'll say, hey, that's where a potential entry is at. It'll also, bull and bear flags can help with your reward risk ratio and win-loss ratio. So in order to increase the reward risk, all right, there's two ways to do it. We can either increase our average gain or decrease our average loss. All right, now, what do you think we have more control of as traders? Increasing how far the market moves in our direction, or cutting off those losers quickly? The one thing we have the most control of is when we get out. We can't tell the market that you need to keep going another 30 points and make me more money. But we can say, this is going against us, I'm out of it, and cut it off quickly. Okay, and that's what we're going to be doing by tightening up stops. It also helps give you actionable setups and helps you more patient with timing trades. For those of you that find you're over trading or you're getting in too soon, this is going to help you with being patient. And you go, okay, I know I have to wait for this setup to occur, and then I can look to get in. All right. So what is a bull or bear flag? Let's talk about it. So a bull flag is at a minimum a 3-bar pattern, okay? It's an up move followed by consolidation where we have a lower high, and we're looking at the wicks here. So the high of the price bar number 2 is lower than the high of price bar number 1 or equally high. All we're looking for is for that market to have stopped moving higher. Okay, so it can have equally high high or lower high, ideally. And then bar number 3 is a continuation bar. Okay, so it's a minimum of 3 bars. It can be more, though. We could have 2 or 3 retracement bars and then a continuation bar. All right, now the way we time an entry into a bull flag, so we have our up move, and then we have the breather bar. Bar number 2, when we put in that lower high, the equally high high, that's our setup. Our trigger is when we break that bar's high. That's where we would go long. Okay? Our stop goes below the low of the retracement. So our stop goes down here. All right? So again, what we're looking for is the market to have pushed forward, taken a breather, and then accelerated again. Okay? Now a bear flag is the exact opposite. It'll be a down move, a minimum 3-bar pattern. So we'll have a down move, followed by a higher low or an equally low low, followed by a break of the previous bar's low and a continuation lower. All right. And how does that work? Our entry, our trigger, is when we break the low of the breather bar. Our stop goes above the high. Now, above the high of the retracement and below the low of the retracement is what we call the no-go zone. All right. Because once it has triggered, the market should not go back above or below the high or the low of the flag. Make sense? So once it's triggered, it should never go back there. That's why we place our stop there. Alrighty, so what does this look like on a price chart? It's going to look like these right here. Now, that's just the price action portion of it. We can't just look at a price bar and say, okay, every single retracement is a bear flag or every single retracement is a bull flag, because you're going to get chopped up if you do that. So there's a few filters we're going to apply, and I'll teach you all of them here in just a second. But first filter we're going to apply is a momentum filter. Okay? How do we use the momentum filter? Well, this is using the MQ momentum indicator down here. You can also use an MACD if you don't have MQ momentum. And all we're doing is we're looking at the histograms. All right? If it's a bear flag, the histograms have to have been red on the down move, been red on the retracement, and stayed red when it triggers. So it cannot change back to green. Okay? A bull flag is the exact opposite. It has to have been green on the rally, been green on the retracement, and stayed green when it triggers. All right? So if we look at this chart here, this is Tesla on a daily. By the way, everything I'm going to show you can be used on any time frame in any market. So you can apply it to Forex, futures, equities, options, doesn't matter. You can do intraday, day trading, swing trading, doesn't matter. I'll show you a lot of different time frames in a lot of different markets so you can kind of get an idea of how it works. Plus at the end, I'll go pull up TradeStation. We can look at some live charts so you can see it on different markets there. All right. But this is Tesla on a daily, for example. Here's our down move, right? Step 1, down move. Step 2, higher low. Okay. Step 3, break the previous bar's low and trigger. So that means you would be selling on this price bar here. As soon as it breaks the previous bar's low, your stop goes above the high. All right. And you see our histograms, they were red on the way down, red on the higher low, and red when it triggered. All good. All right. This is Tesla equity. Okay, this is just normal stock. Here's another one. Here's our down move. Now in this case, we have one higher low. So if it would have broken that bar's low, that would have been a good short, but it didn't. Then we put another higher low. Now histograms stayed red the entire time. So how many bars can we have in a retracement? Well, we can have as many as the histograms allow, basically. As long as histograms stay one color, as long as they stay red, you can still be looking for a break of the previous bar's low. Okay? So in this case, it ended up breaking the previous bar's low on this bar here. So that's where we would have sold. Stop goes above the high of the flag. And again, it should never go back above the high of that flag once it triggers. Then once more, down move, higher low, histogram staying red. So we still have the bear flag. There's our sell. Stop above the high. And then we push lower once again. Now, here's a quiz for you. By the way, make sure you're paying attention because I'm going to be quizzing you throughout. See how well you're paying attention. Make sure you're understanding everything. Is this a bear flag? All right, we have our down move, we have our higher lows, we have a break of the previous bar's low for the sell entry. Is that a bear flag? Yes, no, yes, no, 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 no. Getting mixed. No. Big no. Negatory. Yes, no, yes, no, don't know. So the answer is no, it's not a bear flag. Why? Because the green histogram. Remember, the histograms have to stay the same color for it to be a flag. Okay? And again, we're going to build on this here in a little bit. This isn't the only filter we want to apply, but we're going to build on this. I just want you to get the fundamental part down first. So then a bull flag is the exact opposite. It's an up move followed by a lower high. Histogram's green during the up move, green during the lower high. We break the previous bar's high. That's our long. Stop below the low. And then we continue to climb. And then another up move, lower highs. Break the previous bar's high. There's our long. Stop below the low. Rally again. Retracement, trigger, rally, retracement, trigger, rally. Okay, and all those are bull flags because histograms stayed green. All right. Can we use this on intraday futures? Absolutely. Again, I'll show you some intraday stuff here in just a minute. But I want you guys to understand the fundamentals of what a bull or a bear flag is and how we determine, the filter we use to determine, yes, this is a good flag, no, this isn't a good flag. Okay, this is filter number 1. One second. Sorry about that. So let's keep moving on here. When can we ask questions? I'll be answering questions at the end of the presentation, or you can ask them if it's relevant to the chart that we're looking at. Ask them right now. All right. What's the setting on MACD? Just use default. All right. So let's keep on going here. Now this is what the bull bear flag indicator looks like. All right. The only thing we've done is dots. Okay. So if there is a yellow dot above the high of the price bar, above the top of the price bar, that means it's a pending bull flag. So there's two parts to the flag. Remember, there's the up move, the consolidation, which means pending, and then it triggers when it breaks the high, right? So if there's a yellow dot above, that means there's a pending bull flag. And if it breaks that bar's high, that triggers and it gives us the okay to go long. All right. So in this case, we'd have yellow dot and then trigger, rally, yellow dots, trigger, rally, yellow dot, trigger, rally, yellow dots, trigger, rally. All right. Now, if you have a yellow dot and then the next bar, you do not have a yellow dot, that means something, one of the filters is not meeting the criteria for a bull flag. So it goes pending bull flag and then it goes no longer pending bull flag. So something like the histogram's changed. All right. So in this case, when there's no more yellow dot, that means there's no more trade set up. You don't place a trade. Nothing happened. We were watching it. Potential opportunity. Opportunity never triggered. Nothing happens. Okay. The green dot, all that means is that it has triggered. Now, you do not have to wait for the green dot to show up to get in. You get long as soon as it breaks the high of the bar with the yellow dot. So the next bar, as long as the next bar breaks the previous bar's high and the previous bar has that yellow dot, that means you're good to go. Okay. Does this concept work on any chart type, such as Renko? No, not going to work on Renko charts. What if price retraces more than one bar and then proceeds in your direction? That's all right, as long as histograms confirm. As long as histograms stay the same color and confirm that it's still a valid flag, then it's still a good setup. Can I explain this the silver position. The stop loss, your stop loss goes below the low of the retracement, okay? Stop loss goes below the low retracement. So for example, if we were trading this bull flag right here, we would go long on the break the previous bar's high, and our stop would go below the low of the retracement. Okay? The green dot, all that means is that it has triggered. The flag has triggered, meaning it has broken the previous bar's high. All right? So remember, a flag is up move, bar number 1, consolidation, bar number 2, continuation, bar number 3. All right? Green dot just means we have broken that bar's high. That's where we get long. Let's take a look at a bear flag. Now, bear flags are going to be the exact opposite. Instead of having the yellow dot on top of the price bar, you're going to have a yellow dot below the price bar. And again, this is using the bull bear flag indicator. Okay, so if you have a yellow dot below the price bar, that means if it breaks that bar's low, you have your entry. So right here, it's pending. It never breaks that bar's low. The next bar goes up, and we have another yellow dot, still pending. So if it breaks that bar's low, it triggers. So what's that mean? That means once that bar closes, we have a sell order here. Okay, that sell order triggers on this bar right here, the big red bar. That means it gets us short. Our stop goes above the previous bar's high. Okay, and then we accelerate lower. Same thing here, yellow dot, pending, place our order, it triggers, so we sell, stop above the high, accelerate lower. Same thing here, yellow dot pending, place our order, sell, stop above the high, it triggers, accelerates lower. Now, this is on crude oil on a weekly price chart. Okay, no, this is not for Heiken Ashi bars. All right, it can be 1 dot, it can be 5 dots, it can be as many dots as appear, as long as histograms, as long as momentum confirms. Okay, so let's keep moving on. All I wanted you to know though is this is how you read the indicator. All right, now let me explain to you what the indicator is doing, because it's applying more than just the momentum filter. All right, now because of the way the market moves, we don't want to be trading every single retracement in the market, because not every single retracement is a quality flag setup. All right, one way of overcoming the shortcoming in the indicator was implementing what we call breakout logic as a filter. Hence, if you look at the indicator settings, there's one setting in there called breakout channel. Okay, and what the breakout channel is doing is it's showing you, it's filtering out whether or not we've hit a new high or a new low over the past n number of bars. Okay, so these are the settings on the bull bear flag indicator. We have breakout enforced. If you have that set to true, then that's going to apply the breakout filter. All right, and then we have breakout length. This is how many it needs to have hit a new high or a new low of the past 10 price bars, if it's set to 10. In order to trigger a bull flag, it has to have hit a new high in the past 10 price bars, or it has to have a new low in the past 10 price bars for a bear flag. If you have breakout channel, breakout show channel here, and you have that set to true, then it's going to show you where the channel is, so you can see kind of the breakout logic that's being applied. So what does that look like? This is what it looks like. So this is that same crude oil chart, and I just turned on the breakout channel so you can see it. So it'll change to red. The line will change to red if we're looking for bear flags. It'll change to green if we're looking for bull flags. What that means is that it has hit a new low over the past 10 price bars. Okay, so we've had the lowest low over the past 10 price bars. And then that means we're only looking for bear flags. So bear flag, bear flag, bear flag. So this is just one more filter. So now we have the price setup, the momentum setup, and the momentum filter, and now we have a breakout filter as well. Okay, so we're getting a little more complicated, but I'm building on everything I've taught you so far. So we're taking it one step at a time. Now we're adding a breakout filter. And what that's going to do is it's going to help keep us from getting into a market that is doing like this. All right. Here's another example. This is that Tesla chart. This is on daily. So we have green indicator line or green breakout line. That means we're only looking for bull flags. And it'll be bull flag, bull flag, bull flag, bull flag on the way up. Okay. Now, once again, you don't have to show this. You can set it so that it's invisible, so that the indicator just is referencing it, but that you don't actually see this pattern or see the lines, the green and red and blue lines. Or some people like seeing it on there. It's up to you. I personally have it hidden. Alrighty. Now, even with those filters, we still don't want to take every single bull and bear flag that happens. So what we do is now we have, so the indicator is applying all those filters, and the indicator is looking for price action setup, breakout logic, and momentum filter. Okay, that's what the indicator looks for. Now, us as traders, we have to use our discretion to make the success rate even more. Now, using this stuff I'm teaching you, my average return, for example, with crude oil, I have a mid to upper 70% win rate on a 500 tick crude oil chart. Okay, this is mid to upper 70% win rate with a 1.8 to 1 reward risk. Not bad. All right, but let's talk about how we do that. What are the discretionary filters that we now need to apply? First, we need to trade the first 1 to 3 flags after the initial move. So really the first 1, 2, maybe that third flag. The third flag is kind of iffy. I personally will not trade the third flag in a series. So if it goes like this, if it goes bull flag, bull flag, bull flag, this first one's good. The second one's okay. The third one, it's iffy. Sometimes it'll work, sometimes it won't. The thing you got to keep in mind with any trading strategy is that the further a market moves, okay, the lower the probabilities of that market continuing. So keep in mind, this is a continuation pattern. So we're looking for that move to continue. So the further it goes, the lower the probabilities of success. All right. So the first flag's good, second flag's okay, third flag's iffy. Now, one of the things we can do is we can trade the first flag immediately after a support or resistance break. So let's say a market has been moving sideways in consolidation here, and then we break out, and then you get a bull flag. That right there is ideal. That's what we're looking for. Okay. You can also trade flag patterns with a green candlestick patterns. So let's say we have a bull flag, we go up, we pull back, and then we have a hammer, and then we trigger. That's an even better setup because now we have the hammer in agreement of that setup, and we have a candlestick pattern saying, hey, it should also go up from there. All right. The other thing we can do is after we enter in a flag, the market should never go back below the low of a bull flag or back above the high of the bear flag. Remember the no-go zone we talked about originally? That's why it's a no-go zone. It should never go back in there. That's where our stop is going. That's where we place our stop. All right, the other thing is you can trail your stop behind each consecutive flag. So for example, each flag has its own no-go zone. So if we have a bull flag here and we get long, and then this goes up and we have another bull flag and another bull flag and another bull flag, we can trail our stop up behind each one of these flags because if the market's going to continue, it should not go back into the no-go zone, right? Now, the other thing is the market should move your direction pretty soon, within 3 to 5 price bars, basically. If it's not going your direction within 3 to 5 price bars, it's normally a good idea just to go ahead and get out of the trade because it should ideally snap and start running direction. All right. So one mistake I see a lot of traders making is they place their order, they get into a trade, they place their stop loss. The trade's not behaving the way they think it should. So they go, it should have been running. It's not running, but it hasn't hit my stop loss. So you know what? I'm just going to sit here and wait until it does hit my stop loss. Well, if the trade's not behaving the way that it should, why would we want to let it continue to sit there and go hit our stop loss? Get out of that trade and save yourself the extra 5-10 ticks. A lot of times you'll see me in the trading room get into a trade and then get right back out with a 2 or 3 tick loss or even a 1 or 2 tick gain because it's not moving the way that it should be moving. And like I said before, the one thing we have the most control of is when we get out of a trade. So by doing that, what we're doing is we're cutting off those losers very quickly, and we're allowing those winners to run. All right. So what does this look like? Now we're going to apply all that logic to to an actual chart here. All right, this is the Euro US dollar on a daily price chart. So first off, we have a resistance break right here. All right, we have a resistance break, and then we have a pending bull flag. So we're not taking the resistance break itself, we're waiting on the flag. We have a pending bull flag, it never triggers. So right off the bat, this is a trade that we didn't take, that was a false breakout, and we save ourselves from a loss. All right. Then we have two pivot lows here. So we're going to draw our trend line going across those lows. We break the trend line here. We drop down, and then we get yellow dot, yellow dot. So pending bear flag. That means we place our order to sell. As soon as it breaks previous bar's low, we sell with our stop above the high. That's the first flag after the breakout. Good trade setup. We accelerate lower from there. Bounce back up again. Second pending flag. So this is flag number 2. Place our order to sell right here. Stop above the high. Second flag after the breakout. Also a good setup. Accelerate lower from there. Now, do we want to take, here's your next quiz, do we want to take these bear flags down here? Nope. No. Risky. Maybe. No. Too low. No. Nope. Exactly. We do not want to. All right. Good job. Why? First, this is that third flag, and this is the fourth flag. And we don't want to take the third or the fourth because that's the iffy ones. Second, you're now selling from the bottom of a 800 pip down move. And we don't want to sell at the bottom of an 800 pip down move. When I say 800 pips, I mean we're going from the top 1.15 to 1.107. Now you're chasing the market. We don't want to chase the markets. Up here, this is right after the breakout. So that's the start of the move. By the time you get to that third and fourth flag, you're now at the tail end of the move. Yeah, it does continue to move a little bit lower, but probabilities just are not there, and this is a probabilities game. Now, the thing I want you to notice here, though, is we're ignoring all these other flag setups. Okay? We're not taking every single flag. Again, you have to apply that discretion if you want to get the higher percent win and higher reward risk. All right, here's another example. This is on 30-year bonds. This is on a 5-minute price chart. All right, here's number 1, number 2, number 3. So what is that pattern there? If you know me and you've been in a trading room with me, you know the first thing I always look at is price action itself. This is a head and shoulders pattern. You got it. Good deal. So we have a 5-minute head and shoulders. Here's our neckline. Okay, 163. We break through the neckline. Then we get yellow dot, pending flag. First flag after the breakout. So there's our sell. Stop above the high. Yellow dot here. Second sell opportunity. Stop above the high. Drop down. There's a third one. Third one's a little iffy. It's not the best. I don't really like the third one, as you know. In this case, it would have worked out, though. I wouldn't have been trading it personally. But the first two, they're money. Those are excellent trade setups. So number 1 and number 2. Both really good. Both work out really well. Both of them help you time your entry and catch the run. Now, what happens with so many traders is they'll get in on the breakout right here, or they'll get in after it closes down below, and they'll sell it right there. It'll bounce back up right here, get them out. They'll have a loss, and then it turns around and goes our direction. So what we're trying to do is we're basically avoiding that little retracement, and we're saying, all right, market, you're going to end up going lower. Let's wait and time our entry a little bit better. The other thing it's doing is it's giving us a well-defined stop placement. We know where the market should not go anymore. One thing I always tell people is make sure you have expectations on how a trade should play out. Well, our expectation for a bear flag is it should not go back above the high of the retracement. Expectation for a bull flag is it should not go back down below the low of the retracement. All right. Let's take a look at another example. This is crude oil on 2-minute price chart. So in this case, we have support here because we came down, pivoted off it again. We also have a trend line that's going up and across the lows. We break through the support. Then first yellow dot for pending flag. That means we place our order to sell. Stop above the high of the retracement. And then accelerate lower. Then what happens? We break this pivot low, which is another support level. First flag after that support break, right here. Pending yellow dot. Breaks that bar's low, that's our sell. Stop above the high of the retracement. Accelerate lower yet again. Now, here's your next quiz. Do we want to trade this flag here? Yeah, Cross. I do like using 500 tick chart for bonds the majority of the time. It works excellent on a 500 tick chart. No, we do not want to take this third flag. You are correct. However, we do want to be trailing our stop down behind that high because that's a no-go zone. So now we've entered from up here. Our stop was up here. So we have this much risk. And we're exiting down here. And we have that much gain. Not a bad reward risk ratio. You have about a 3 or 4 to 1 reward risk there. The second one, you have about a 2 to 1 reward risk. Remember, the better that reward risk is, the easier it is for you as a trader to be net profitable over time. Alrighty. So let me show you. These are back-tested results. Now this is just using the indicator if we took every single bull and bear flag that occurred in crude oil between 5/14/2001 and 5/2/2016. Okay. This is what the return would be if you just took every single flag. But because we're going to add discretion, we can make that even better. This in and of itself isn't terrible, but it's not too amazing in my opinion. I mean, as you know, and you saw my equity curve goes like this, and I'll show you some other people's equity curves that I've worked with here as well. In just a minute. All right, here's if we took every single bull and bear flag back tested in Tesla on a daily price chart between 2010 to 2016. Okay, not bad. But the thing I want you to notice about this is it's 2 steps forward, 1 step back, 2 steps forward, 1 step back, 2 steps forward, 1 step back, 2 steps forward, 1 step back. All right. I'm not here to tell you you're going to win every single trade. Nothing does. Nobody does that. It's not true. Okay. Anybody that tells you that you're going to make money on every single trade is lying to you and you should run. All right. However, what we're doing is minimizing our risk, which in turn, instead of having what most people's equity curve looks like, which is 1 step forward and 2 steps back, 1 step forward and 2 steps back, we're doing the exact opposite. We're going 2 steps forward and 1 step back over and over and over again, which is exactly what we want. All right. Can you pyramid on your original position if you have a second flag? Yeah, you can if that's the way you like to trade. All right. Now, looking at everything we just went through and looking at how you use bull and bear flags and how we use bull and bear flags as time entries, do you see why timing is so important to your trade? You see how it can lower your risk by giving us a defined level to place our stops. You see how it can help you with increasing your reward risk and your percent win. Now, how many of you want to know how you can take the next step and actually get this indicator? All right, so the indicator is available on, it's available on TradeStation, Thinkorswim, eSignal, Sierra, Infinity, Multicharts, NinjaTrader. I'm going to go through and do a Q&A here in just a second, and we're going to look at live charts. All right, but it's on TradeStation, Thinkorswim, eSignal, Sierra, Multicharts, NinjaTrader. You can get it. The indicator is normally $4.97. However, like I said before, we don't want to just leave you on the side of the mountain and say, here's the indicator, good luck, and just take your money and do that. That's not what we're all about. So what we're going to do is we'll also give you a month of platinum membership. So you can come in and you can see us in action, see how we trade in action, either in the options trading room or in the futures trading room. And you can see how we trade with these live. And remember how I said we always start everybody off in base camp with Acclamation? We're also going to give you the Acclamation Workshop. Now, normally this would be about $850. However, we're doing a special for the webinar today, and it's only $497 for today. So you're getting the Bull Bear Flag Indicator plus a workshop that teaches you how to use the Bull Bear Flag Indicator. That workshop's about 2 hours long, I believe. Plus you're getting a month of Platinum membership. Plus you're getting an Acclamation Workshop, all for $497. All you got to do is go to bctnow.com/BBF. There's a link, bctnow.com/BCF. Now let me show you these are some equity curves that some of my students have sent in. Now this one's from David. He just started going live, okay? He just went live. He had been a losing trader over and over and over and had never been successful. He just went live. So you're probably going, well, that's not the best looking equity curve. But it is. And the reason I say it's good is because look at the reward risk. It's that 2 steps forward, 1 step back. 2 steps forward, 1 step back. 2 steps forward, 1 step back. Okay? It's a one-time fee. All right? Yes, if you don't know options or futures, you can benefit. You'll come in and you can learn how to trade equities. All right, Dave trades equities in his room. If you trade Forex, you can ask questions about it all day long. I'll be happy to pull up Forex charts and tell you my commentary and tell you how I would be trading it. Now, this is Dave. Remember I told you Dave, who became a professional trader, this is what he did for a living to pay his bills. This was his equity curve. This is when he got to the point where this is what his equity curve looked like for several months. Then he went and said, okay, I'm going to do this full time. And he continued to grow and grow and grow and grow. At the time, like I said, his original account value was like 10,000 or something. And he was well over $100,000 account value. Plus he was paying his bills from his trading. Same price, Chris. Here's Andre's equity curve. Now this is Andre's. He trades differently than both David and Gliss. Andre's trades pairs. All right. But his equity curve looks excellent. And he's focusing mainly on intermediate pair setups. But that's his style. Like I said before, there's not any one way to trade that I think you have to trade that way. There's a lot of different ways that fit everybody's style, different trader style. This is Lori's equity curve. These are all people, by the way, I've worked with on one-on-one basis. I've worked with getting them to the point that they want to be. And these are all live trading equity curves with real money. This is Lori's equity curve. Hers looks even better than mine. All right. And she trades differently than both Gliss, Andres, and David do. This is Sam's equity curve. All right. Now, Sam actually sent me previously an equity curve of his where he had blown up. He'd sent me 2 or 3 different equity curves of him blowing up accounts. This is what his equity curve is looking like now. And he said, the results, knocking on wood, are almost perfection. I've attached my 2 previous blown accounts, equity charts, plus the progress of last week and this week. I'm so happy with what I've accomplished so far, and yet more to come. I'm gaining back my faith and strengthening my confidence towards a brighter future soon. Thank you, Mr. Thomas Wood. All right. Again, to get it, it's bctnow.com/BBF. Now give me 1 second. I'll pull up TradeStation here. We'll do a Q&A and I'll show you some. So here's TradeStation. This is crude oil, by the way. Here's an example of textbook what we're looking for. So here's our support. Okay, pivot low, pivot low. This is on a 30-minute price chart. We break through the pivot low right here. Yellow dot, pending bear flag. Triggers the flag, accelerate lower. Flag number 1. Here's flag number 2. Here's flag number 3. All of which worked out really well. Yeah, Moneyball, you can do that as well. Yes, you can adjust the sides of, or the size of the dots, I believe. Can I turn on the channels? Sure. Show breakout channel. You just set that to true. There you go. Now the channel's turned on. Now you can go look at something like, here's the S&P. Okay. So here's your consolidation. Here's your breakout. Here's your yellow dot for the pending bull flag. And there's a trigger and acceleration. Here, let me turn off value bar so you can see a little bit easier. I'll make a candlestick chart as well. There we go. We'll get rid of MQ momentum also. All right, so break out of the channel. Yellow dot triggers, accelerate higher. What is better to trade with, the trend line breakout or with the channel breakouts? Either or. You're waiting for the breakout to happen, and then you're timing your entry after the breakout using the flag. So it's the first flag after the breakout takes place. All right. Do you have a recommended P&L program? Not sure what you mean, MJ. A recommended P&L program. Does it work on mobile? I'm not sure, to be honest with you. Let's go look at Tesla on daily. So here's a daily Tesla. Oops, I'll make this bigger. All right, here's Tesla on a daily. So here's your resistance breaks. So if this is resistance, you break the resistance, bull flag 1, bull flag 2, bull flag 3. All of them worked out perfectly fine. Next resistance break, you're gonna have right here. Break through the pivot high. Okay, breakout, bull flag 1, bull flag 2, bull flag 3. All of them worked out perfectly fine. That's how much I just signed up the monthly membership after I was hit by a huge loss this week. Can I know, is there any way to get one-on-one mentorship by you? Daisy, send an email in. Send an email, support@basecamptrading.com. Why are the yellow dots below the bars and not above? So if the yellow dot is below the bar, remember, it's a bear flag. If the yellow dot's above the bar, it's a bull flag. Okay? If you're trading a 1-minute chart or any length and get 3 flags, and you go to a 15-minute chart or a higher time frame because you believe in fractals, and the 15-minute chart has only had 1 flag in your direction. If you have less than 3 flags on a 15, could you continue to trade the flags on 1 minute until you get the 3rd flag on 15? So if you're using multiple time frames and you're saying that the longer time frames have not hit the limit yet, can you still continue to take the shorter time frames? No, because the shorter time frames, you're expecting it to go into consolidation. So once it goes back into consolidation on the shorter time frames, then you can start looking for it to the count resets. So every time you go back into consolidation, the count resets. Does that make sense? So if that 1-minute chart resets, which it would do if you have a 15-minute flag set up, that pending flag, when it has 15 minutes of going nowhere, that's going to be a reset for the 1-minute chart. Does that make sense? Because it'd be 15 minutes of the market going nowhere. Sorry, there's a lot of questions coming through. Yes, it is recorded, D. I want to get it up on YouTube probably on Monday. Yep. Tony, I'm going to have this recording up on Monday on YouTube. Do you have to wait for the close of the candle after the break? No, you do not have to wait for the close of the candle. As soon as it breaks the previous bar's high, it triggers, and that's where you're getting in. How does this work with Trender Pro, and how is it best to use them together? You use the Trender Pro as an additional filter. So if you're looking for bull flags, you want to see a green Trender Pro. So here, I'll turn on the Trender Pro so you can see. Oops, it's a paint bar. What? Maybe it's not working. Not sure why. But you can use it as, here you go. You can use it as a filter and apply it to your charts there. All right. Sorry, for some reason my Trender Pro is messing up. I'm changing over to a new TradeStation account. And that's why my TradeStation's been kind of acting crazy here because it was asking me to sign more forms before it would let me log back on. Pet Merlin for you. Sure thing, Jerry. The course teaches you how to use the indicator. Yes. Can I know how to combine this with the naked trading method? Higher high, higher low. Or is this another breakout strategy? You can apply this with naked trading in a sense that you'll say, all right, you're going to look at the price action first to know when the channel breakout is or when the consolidation breakout is. And then you'll time your entry. Instead of entering on the breakout itself like you would with naked trading, you apply a bull flag as your entry. You enter on the break of the high of the previous bar's high. I'm not going to put up a range bar right now. It's too complicated to get it all set up at the moment. But all right, everybody. I hope you guys enjoyed it. Again, if you want the indicator, MQ Bull Bear Flag indicator, plus a month of membership so you can come in and see how the trading room works, see how it's all done live every day, get you access to the end of day setups and all that good stuff as well, plus the Acclamation Workshop. Just go to bctnow.com/BBF. When you go there, it's going to bring you to this page right here. Bull and Bear Flags indicator. All you got to do is put in your information. You can see right here it has indicator, Bull Bear Flags, Acclamation Workshop, and Platinum Membership Special. Put in your information, complete your purchase, and you will be good to go. All right, so I want to thank you all for coming out. I hope you guys enjoyed it. I will see you all hopefully on Monday in the trading room, bright and early Monday morning. Have a great rest of your weekend. And until next time, happy trading, everyone.